AT&T stock offers passive income investors a dividend yield of 3.9%. Meanwhile, Verizon offers dividend stock investors a yield of 6.3%. But which one is the better dividend stock to buy for passive income investors right now? I'm going to answer that question by comparing these two across some important financial metrics and also sharing with you my proprietary discounted cash flow valuations for these two dividend companies and answer the question which one I think makes a better long-term investment today. Let's get into the details. Of course, one of the more important things that passive income investors look at when considering the dividend stock is the dividend yield. And these two offer a relatively healthy, robust dividend yield, with AT&T offering investors a 3.9% dividend yield and Verizon offering investors a 6.3% dividend yield. But I often say when you're looking at dividend stocks, you need to look beyond the dividend yield. You need to understand the companies and understand if these companies can sustain the dividend, can increase the dividend, and whether or not the stock price means that you're going to achieve capital gains or capital losses. Remember, when you invest in a dividend stock, you're exposed to changes in the stock price, meaning you can get a dividend yield of 6%, but if the stock price falls by more than 6%, that wipes out your entire return on that investment. So you've got to understand the overall picture and understand the overall valuation to determine if these stocks are good dividend stocks to buy. These are not like bonds. When you buy a bond, you get the yield on that bond. If you hold it to maturity, that's the only return you will experience. You won't need to consider the capital gain or capital loss from a bond because those are predetermined. Whereas with stocks, you need to consider the capital gain or the capital loss because those are not predetermined. That's a risk in investing in dividend stocks. But with risk comes a greater potential for greater return. So one of the more important things I consider when investing in stocks is the return on invested capital. And what I like to see is companies that have a return on invested capital that's above their weighted average cost of capital. And we don't really see that with Verizon and AT&T. These are heavy capital expenditure industries. Verizon and AT&T every few years need to invest tens of billions of dollars in upgrading and maintaining their networks. And if they don't do that, they expose themselves to the chance of being out-innovated by another company that will invest in the infrastructure and take their market share. Click the link below to watch the full video.